Just got your bounce back loan into your limited company? You want to take it straight out and do some cool stuff? Well, in this video, I want to show you some really important information so that you know whether that's a good idea or not. As a business accountant, my team and I spend all day long helping business owners on their journey. And as you can imagine at the moment, bounce back loans are a really big deal. We're getting lots and lots of questions around them. And one of the key things we're seeing a lot online and also talking to our clients is people want to know, I can get this money in. If I can pull it into my limited company, can I take it right out and do some cool stuff with it personally? Can I pay down some personal debt? Can I buy a buy-to-let? And all these things. Now, in some circumstances, the answer is actually, yeah, you probably could. However, and it's a big however, there are a lot of reasons and technical things you need to consider as to whether this is a good idea or not. And in actual fact, in the majority of circumstances, the advice tends to be don't do that because you're going to end up with a problem. However, in some circumstances, it's possible. So before I get into the detail of how, why, what, and when, if you like this video, make sure to click the subscribe button below so you get notified whenever we release more just like it. Right, on to the technical bits.
So here we are, this is a balance sheet. This is the document. It could be called other things these days, but most accountants and people still refer to it as a balance sheet for a limited company called BBL Limited, quite apt. And this is a document that really shows the health of your company. And I suppose for me, the main thing I would explain is that the idea of the document for me as a useful tool as a business owner is if you shut the company down on that particular day, in theory, this bottom highlighted figure here is what would be left for the owners at the end of it. Now, it's not always true for various different reasons, but it does give you a really good indication of the health of the company and what roughly would be left. I know we spend time talking to clients about it, and we quite often call it the pot, what would be distributable at the end if it all shut down. Now, in this example, someone's taken the full whack of 50 grand on their bounce back loan, and it's sitting in their bank with the 10 grand they already had in it. They're owed £3,000 from their customers and they owe HMRC £2,000. And what I wanted to show you is what happens if you drew the whole loan straight out. Now, firstly, I'm just going to show you what happened if you drew 10 grand, because we're saying the pot here is 11 grand. On paper, they have 11 grand available to them, or for technical reasons, £10,999, but let's just call it 11,000. Now, that's because if all their clients paid them today, they'd have £63,000 in their bank, and they'd only have to part with 50 back to the BBL bank, 2,000 to HMRC, and they'd be left with 11 grand of cash. So that's how that works on the balance sheet. Now, so in theory, if they were to draw 10 grand out, well, that's available to them as a dividend. If they're presuming, we're going to presume you're the owner and the director in this case, is so often the case with small companies. So if you did that, I'm just going to show you now. You can see we've declared our dividend of £10,000. We've still got our other grand that we could take at a later date, and you can see the cash has gone straight out the bank and straight into the owner's pocket. So that's all okay, that's cool. The danger is when you decide to take it all out. So, and this actually happens in the majority of cases that we're seeing at the moment with companies that are in trouble. They might even be in this position when they start, where they've had no money in there. They've just put 50 grand into the bank. None of their customers are paying them, and they've not paid HMRC because of delayed VAT and all these other things. And as a result, they've only got this grand to play with anyway. Now, if you drew 50 grand out, what happens here is that the cash has left your bank. It can't come out of this pot, as we call it, because you've only got £1,000. We could have done £1,000 of it, but right now, let's just presume there's nothing in there really, because it's almost not. And that is because so the only place it can go is as a repayable amount. So it's shown here in the balance sheet. The company shows that actually it's got an asset due back to it of 40,000. So it is expecting the director to repay that money. Now, so we've seen quite a few things of people going, I've taken these BBL and then I'm going to go and pull it straight out of my company and pay it down on a buy-to-let. Well, that's cool, but your company is going to show it as wanting to pay that money back. You could, in theory, declare it as some salary. Some people have talked about that, where you could actually pay that properly, and without boring you with the technicals, it would actually reduce this figure here. That's all okay. But for lots of different reasons, you're not really acting in the company's best interest, and it will cause you a whacking great tax bill that will increase this amount of money that won't help either. So that's not really something that's that desirable. However, technically it's possible. So you can do this, but generally this would be the default treatment, is it would go on here and say, right, you owe it back to the company. Now, if the company goes on to make loads of money and goes back into the similar position to what it was when it started, where we started to generate more and more funds. So if you imagine, what you can't see here is the company making money. So as the company makes money, it sort of goes into this retained profits bit. And then there'd be more funds on paper to say, because you'd see more cash coming in or more money that was owed from clients up here. And there'd be more money to say, okay, well, actually now let's pay some of this off, transfer it out of this pot against my loan account to repay it. It's a very technical piece, but I just want you to sort of see how this might look. Now, the problem with this is that you start a ticking time bomb. When you've got an overdrawn loan account, when the company year end comes, so let's say the company year end in this case is the 31st of July 20, you've got 9 months of which to clear that loan. If you don't, you're going to pay 32.5% on the balance of that loan. So in this example, that could be nearly 13 grand of tax that the taxman's going to want in not too long a distance. That tax is a holding tax, so eventually when you repay that loan, presuming you do, you'll get it back, but it takes years, and obviously you're going to lose another 13 grand in the meantime, or certainly the taxman is going to be chasing you for it. So that's the biggest issue with this particular scenario of you taking it out, is you owe it back. And there's no other way of doing it unless you're going to declare yourself a big salary. But again, for lots of different reasons, you can get yourself in problems with that. So there you go. That's a quick rundown of what the company accounts would look like if you took your BBLS straight out of your company.
So if you've enjoyed this video, make sure to subscribe below and share it with your friends, your network, and anyone else who might benefit. Until the next one, we'll see you then.